All right, so welcome to this video, and in this segment, we're going to take a look at mean reversion. So do prices in the stock market always revert back to the mean? That's kind of the bigger topic and concept that we'll be covering in this segment, and we'll go in quite a bit of depth. So looking at our overview, we have what is mean reversion, evaluating standard deviation. We'll look at a real world example, mean reversion on the charts, two ways to trade mean reversion, and then also how to use that mean reversion when it comes to trading options. Now, the thing, when it comes to trading options, that's going to be way beyond the scope of kind of this video or the channel that we produce on this channel. Instead, you may want to take a look at our other channel like Traders Fly, there where we cover a lot more when it comes to option trading. So if you're getting into options, highly encourage you to take a look at that over there. Anyways, so let's kick things off and look at the first part, which is mean reversion. What does it mean when we say prices revert back to the mean? Thing is that when we look at mean reversion is that prices can be at a high point or a low point. Let's say you're looking to buy a pair of shoes, and that pair of shoes is $100 at one store, and at another store it's $80. So the thing is that their true price is not really displayed. You could say, hey, one store is 100, is that the true price? And one store is 90. Is that the true price? It's really kind of a combination of both. To get kind of a real dynamic understanding of price, you may need to go to many stores, maybe 50 or 100 stores, calculate all those prices for the same model or the same shoe, and then get what the average is. And that's really more of the true price in nature. And that's what, when it comes to mean reversion, that's really what we're looking at, is that usually price is always at a high point or at a low point, and the true price is somewhere in between. So this is what we're talking about with mean reversion. In fact, if you take a look at this website, this is Camel watching Amazon product reviews or products, looking for prices. If you take a look at, let's just say, the Dyson product vacuum cleaner, we'll look at this one, V8. This is just kind of what kind of popped into my mind here. Let's look at the 1-year price, and you can see what's happening is that this product, and we'll look at just on Amazon, the lowest price was $284. The highest was $469, and current is $382. So the average is $379. So when you start looking at pricing in this way, what you'll find is that more of the true price is $380. And if right now you're going to pay $382, you'll pay just a tad bit over kind of the average. And you can compare this across a lot of different products. So again, looking at this vacuum, this one, kind of the highest is $649, the lowest is kind of $400, and right now it's $649, averaging around $600. So the thing is you're going to pay top dollar. Lowest was $399. So in fact, if you can get this somewhere around $400, you're kind of getting it at the lower level. So the thing is that when we look at mean reversion and we look at prices, we're really looking at, our stock price is going to come back down. Now, I will say stock prices, they're not like a regular marketplace where you go in to Walmart and you're buying toilet paper or razor blades or those kinds of things. They work a little bit different, and they can continue to appreciate with time, much more so, rather than, when it comes to general product pricing, it behaves a little bit different. Okay, so keep that in mind as you go in and evaluate stocks, because they can continue in trending up just due to the perceived future outlook. Okay, let's take a look at kind of the second part of our video, and that is evaluating standard deviation and finding the average. So when we start looking at these types of things, what we're really looking at, and if you haven't heard of standard deviation, we're looking at kind of like a bell curve. And one of the simplest examples for this, and I'm just going to use this as a general guideline, is we're going to say people's average height is 6 feet. And let's say the core, or most people's height, is somewhere between kind of 5 feet and 7 feet. So this is kind of the bulk or the majority. Okay, so they'll fit in this bracket. Okay, however, when we look at kind of the outliers, there's probably people that are a lot smaller and people that are a lot taller as well. And let's just say, for conversation's sake, we're looking at kind of people's highest point in their life through their, up to their death. So in some cases, people don't really grow that much at all. It might be, let's just say, 1 foot or 12 inches or 30 centimeters or so. Could be like a baby that died on the table, and now you've got a lot smaller as far as their max height goes throughout their life. And then you've got other people that I think in some cases could be like 8 foot tall, where again they just have a growth gene or something that's accelerated. So in some cases you have prices that go way further, way higher than anticipated because it's not the norm. In other cases, they go much lower as well. So this is kind of what happens when we look at standard deviation. But the core price here is usually in bulk. So looking just like at those vacuums, what happens is maybe you have a range between $500 and $700, but there might be times where that vacuum you could get it on sale for like $300 or something, like a Black Friday or Christmas special or something in that range. Or in other cases, maybe if you didn't do your shopping or due diligence, you could pay, let's say, $1,000 for something as well. So that's kind of what standard deviation is that you're encompassing the bulk part of this. And when it comes to prices, you can also use it to kind of fine tune or look at those things as well. Looking at our part number 3, let's look at a grocery store example. So we've kind of talked about this in our beginning stages. But really, when we look at things like blueberries, and we're looking for blueberries, you might see prices around $3, $4, $5, and prices they're constantly wiggling around all over the place, right? And what you're really doing is, as you know and understand that product, you get an idea of, are you buying at the lower point or buying at the higher end. So for example, right now, if I'm paying about $8 for a basket or case of blueberries, that's probably a little bit high and expensive. Why? Because I know just the other day I just bought blueberries for $2.98, and in this case, I know, hey, that's at the lower end. Now, sometimes you'll see prices maybe at $3.98. So you could say, hey, I'm kind of in the average zone. And then you may choose, hey, I'll still buy it, or maybe I won't. And that's the thing, is that when you know those prices, that's great. The problem is that in the stock market, you don't always see this. With blueberries or a general grocery store example, it's easy to see because you're constantly purchasing that product, usually at a recurring basis. Same with like cereal, or it could be the meat, the deli, or those kinds of things. You're purchasing those things time and time again, so you know if they're at a high point or at a low point. And that's you get comfortable with the pricing. So that way, if you're at the upper end of paying, let's say, $7 for a case of blueberries, or maybe $3 for that. And as price is wiggling, depending on the store, that's you're able to now make a distinction of, is it worth the purchase? Okay, let's take a look at our next step, and we're going to evaluate mean reversion on a stock chart. So when we look at a stock chart, and we'll pull this up right here, what happens is on the stock chart, I'm going to put on a moving average for this to get a little bit of a understanding for mean reversion, because what happens is let's take a look at, we're going to go look at Apple for this stock. Okay, what happens is price gets further away from the mean, and then eventually it comes back to the mean. So here is our example with Apple, and what you'll find is that this is a moving average that we have right here, this yellow line, and eventually at some point the stock price kind of gets away from the average, and then it comes back. Okay, and sometimes we're at a lower point and then it comes back into the average. So as the stock's trending, the thing with stocks is that it could trend or be higher price for a while. Kind of like, think of this as like blueberries for $5, if normally they're $3, $5 for a long period of time. And then it can pull back and get into a lower value. Okay, so it is a little bit different from grocery stores in that case, that these things could trend up for many, many times, but compared to the average, are we still above that zone? So looking at, in this case, we got too far away from the average for maybe too long of a time period. So that time period was also quite long and lengthy. And then that price reverted back. Okay. And now we came back into this level and we kind of played around back and forth. And here we're at the lower points and then we're at the higher points and then we're coming back into it. So the true price is somewhere in this average. And that's how you would look at mean reversion into the stock charts. Now, I will say there are two ways to kind of trade mean reversion, at least at a basic level. So this gets into our next segment. And in these two ways, we're just looking at the stock chart when we're looking to trade these at a directional basis. Now, when it comes to option trading, there's many more ways that you could do this. But from a basic example, most people, I will say, when a stock gets into the mean, they're looking for it to break away from the mean. So this is going away or out from the mean. They're looking for a breakout, right? As a long investor, they're looking for things to break out. And this kind of also accelerates that process that if the stock is breaking away from the mean, that could also mean breaking away from here because the stock is at the mean at these points. Well, it's breaking away here, but it's breaking away to the downside. Or on this case, we're breaking away to the upside. Here, we're breaking away to the downside. So we've got kind of two different things happening here, but they're breaking away. Now, what you could also do from a trade is break into the mean or break to the mean. So if you go in and buy at this point, because it's far extended away from the mean, you could say, okay, well, it's going to come back into the mean, and then you could do the trade right there from this point to that point. So I'm going to zoom in a little bit here so you can see. And now you get an idea of, okay, I'm over in this case, and it's breaking into the mean, okay? And same thing over here, where the distance from the average, we're looking for it to break into the mean. There it is. That was your trade from here to here. So you got into it. It went into the mean, and then again, it broke away from the mean. So as you start looking at things in this way, it actually allows you to have a lot of different opportunities when it comes to trading. Now, some cases you can get even longer extensions where if you caught this, where the stock is far away from the mean, so here was our farther away from the mean, and let's say you wanted to say, hey, we're going to break back into the mean. Well, you put on this trade and it's away from this mean, and it's coming back in, and then it goes and shoots past away from the mean again, and now you've got kind of a double win. So you won over here and you won over here, and now you've got kind of a very extended period of time. So this is where these things can really play a nice role, where stocks are, if they're overextended to the downside or the upside, it can work in both cases. So similar to up here where the stock is a little far stretched, even over in this area or this area, you can say, hey, I'm going to put a trade on, even if it was over here, it's going to break down into the mean, and then it even exploded past the mean. So what's happening is prices are always oscillating. And if you think in this way, it gives you a lot of flexibility. Now, let's go into our final segment, part 6, and this is how to use the mean reversion with options. And if you're doing a lot of things with options, I definitely encourage you to take a look at kind of the coaching that I do on the website on Traders Fly. There's a lot of things on there, and there's also great courses as well if you're kind of a DIY person. But when we go in and look at things with the options world, you can also do things kind of like non-directional or even directional. So let's say a stock is extended away from the mean. So if we look at Apple, and right now it's kind of close to the mean, but you might look at Win a little bit kind of here or there. Let me see if I could find one that's a little bit far away from the mean. So here's WDC, it's far away from the mean here. You could try and trade it to the downside. If I look at maybe CVS also, you could see it got far away and pulled back into the mean. And then there's other stocks like maybe Nike that was also far away and pulled back. So what you can do is when a stock is further up at this level and pulling back, you could trade it directionally with options. One way to do that is, let's teach it from the bullish side, is we'll go in and do a Nike example. Like let's say you believe Nike was too far stretched to the downside. And again, tweaking this average really is up to you. I'm using a 20 right now, but if your average that you were looking at is more like a 15, you could fine tune it Here, let me fine tune this average. I'm using, sorry, not 20, 89. Let's go to maybe a 20 moving average. Okay, and now that we've got a 20, you can say, hey, we're far away from this. Okay, and now you say it might snap back into the mean. And when we look at this from an options basis, I might say, well, I'll trade Nike to the bullish side or to the upside, and I could place a bullish vertical spread. And now that you buy the 104, sell the 105, you can say, okay, I'm looking for this to reverse back to that upside. And this is one way to do it from a mean reversion. So you're risking, like, call it $1,000 to make $1,000. And of course you could spread your position out a little bit more and then do a little bit less contracts. So you've got risk 1,000 to make 1,000. And if that stock pops a bit, that's all you're looking for. You're looking for mean reversion. So there's a lot of ways to trade that, especially in the options world. And if you were bearish, you could do it the other way, going to the downside, like buying a vertical over here. And now you can construct a bearish view on that position where you're looking for that stock to pull back. But the point I'm trying to make is there's many ways to trade those mean reversions when it's coming to regarding options. As for choosing your kind of mean or average, in this case, I'm using a simple moving average. You could use an exponential moving average. There's a lot of ways to tweak it. Also, depending on the amount of length of the average, like in this case, there's 20, but let's say we bump it up to 30. What it'll do is take the last 30 price bars and smooth them out. And you'll see that here in a second. And now you've got a whole different average. So which one do you choose? Well, if you like to trade more often, more frequently, you'll probably choose a shorter duration. You'll get more signals, but it'll fake you out. So the runs or the movements will be kind of, taking a look at that, they'll be short, right? Coming back to the average. However, if you prefer longer runs, in that case, you may want to choose a longer moving average. So it just depends on the length of time you like to be in the trade. And that's what I would say is play around to looking at charts, and that way you can see how long do I like to be in the trade, or what type of average do I like to look at, and then you'll get a better idea. Some people, let's just take a look at 125 here. Mean reversion, you can see this distance, yeah, quite a bit, even over here. Wow, that's quite a bit. And then the mean reversion came back into here. So, and the same from this point to this point. So what I'm saying here is that you can change that time frame depending on how many trades or the type of trades you like to do or take. So in your case, it might be a longer time frame. For other people, it could be a shorter time frame. So when you're looking at things, how far is that distance stretch from those averages? The more stretched it is, the more you may want to take a mean reversion trade, and then it's pulling back. But here you can see you've only had kind of 1, 2, 3, maybe 4 or 5 signals. But if you want to trade more frequently, then maybe 5 or 6 times a year per stock, then you may want to choose a different shorter duration moving average. Anyways, hope that helps. I truly appreciate you sticking with me and joining me. Don't forget to check out the video courses on the website. There's a lot of great content and material there. And if you're interested in kind of the one-on-one coaching, I also encourage you to take a look at that as well. Feel free to look at our website, Trading Webinars. There's also great freebies in that website. So sign up with your email address and continue to learn and evolve. Thanks for joining me, and I will see you in the next video. Take care.